Welcome to Silicon Valley M&A Insights. My name is Jeff Roach. I'll be your host today. This is one of a continuing series on demystifying the M&A process. Today we welcome Virginia Turezyn of SiVal Advisors, who will enlighten us on selling a business to private equity. Let's welcome Virginia Turezyn.
Thank you, Jeff. In terms of agenda today, what I'd like to cover are various aspects of the PE sales process. I'll go into a little bit of background on SiVal and then jump right into a private equity overview and walk through various aspects of the process. In terms of our team, we're led by Jan Robertson, who's our co-founder. Jan has an illustrious career of doing over 250 transactions over her 30-year career. Solely as an investment banking M&A expert. She led Needham's activities in the U.S. and was with RBC in Canada. She's one of Silicon Valley's top 100 women of influence. My background spans corporate M&A, private equity, venture capital, and my background is a CPA. Throughout my career, I have started new activities and entrepreneurial endeavors within larger organizations. Most recently, I led the acquisitions at EAG as head of strategy and business development, and we sold that company to Eurofins for $780 million. Throughout my career, my expertise has always been on the buy side, and I decided to help entrepreneurs understand what buyers are truly looking for as they undergo a sale of their business, which is their most valuable asset in most instances. Jeff Roach, whom you've just recently heard, is a strategic partner with us and has a 30-year career in enterprise software as his specialization. He's a marketing expert, and we have a broad team of technology and executive experience running businesses, building companies, and we understand how to build and grow businesses from an entrepreneur's perspective, and we leverage that as we undergo sale processes for companies. To give you a little bit of background on SiVal, the company was founded in 2002 and focuses on growth companies in a range of industries, predominantly technology. We also work in networking and communications, medical device and services, manufacturing, software, services in general. And we take a global look at businesses in terms of selling them. We do strategic advisory work and focus on the mid-market businesses. As we execute strategic transactions for technology companies, it spans the areas of corporate advisory, which is really strategic planning to be ready to execute a transaction. Our main focus is sell-side advisory, where we help companies sell their business through a very competitive process to maximize exit value. We also work for large corporate entities on a global basis, looking for strategic acquisitions in core areas. And we do valuation work to help assess based on strategic versus financial valuation metrics to provide entrepreneurs with estimated market values. Jumping into private equity. As many of you may know, private equity firms manage capital for institutional investors, pension funds, and high net worth individuals. And they have a fiduciary responsibility to secure high growth opportunities to maximize the value of their funds. The commitments are typically pooled into 10-year investment vehicles, and the partners generally hold the investments for 3 to 7 years prior to again selling the business, hopefully a much larger entity. PE firms typically make control investments, but they'll do majority or minority investments as well. And they partner with management to continue to grow the business. PE firms are in the business of making money for their investors. And their goal is to buy attractive businesses at low valuations, and then they supplement the businesses with new management team members and additional acquisitions to grow the company and ultimately sell it at a much higher valuation in the future. And the partners within these firms share the profits in what's known as a carried interest participation. Think of it as 75% of the funds going back to the initial limited partners and 25% retained by the owners of the firm to share in the exit value. The way PE firms generate returns, it originates in how they do the deal up front. They do extensive upfront due diligence to assess risk and identify opportunities for growth. They're thinking all the time about ways to improve operations and performance to yield higher profit margins, EBITDA. Typically, these firms, the partners on the deal, will provide additional capital for CapEx spending, improved sales and marketing, and expansion into adjacent markets. And these are things that typically founders are unable to do in terms of extending all of their assets and putting everything at risk on an ongoing basis. At some point, they take money out of the business and they don't put as much back into the business. And so with a new owner, they can take the company to the next level. In doing so, PE partners typically seek additional acquisitions, and you can think of it as a hub and spoke strategy. There's usually a platform company around which they grow and expand, and they focus on leveraging best practices across the company from all the various entities that they may have acquired, and they'll typically implement strict governance procedures and comprehensive financial reporting with strong analytics and metrics. They will generally retain key employees and provide further incentives as the business grows, and their goal is to become a dominant player in a given industry. PE firms actively engage with management, and they advise on pivotal strategic decisions, and they're attuned to key performance indicators. They do not run the business. They have a management team, which is generally existing members of the company as well as supplemental team members that they bring in. They provide critical thinking, new ideas, an expansive network for commercial transactions, access to far more capital than an entrepreneur typically has access to, and this can be in the form of equity as well as debt. They'll come up with innovative financing structures and are a source and pool for talent. In many instances, they offer existing owners a rollover opportunity for potential additional future upside. They want that owner and their team to have skin in the game to continue to grow the business. Their investment criteria focuses on very critical elements, which I will address in the next slide. And the differentiation between a platform and an add-on acquisition, which you may be interested in knowing. A platform is generally the base business that you will build around. It's typically the business that'll have higher revenues and EBITDA. And an add-on is to enhance that platform in different areas of the business. It may be up and down in terms of an industry segment, or it may be in adjacent market segments. Platforms generally command higher valuations. Think of it as the stronger the business, the higher the potential valuation. And add-ons are typically lower on the valuation curve. They're smaller, they don't have as much infrastructure, but they're very beneficial to a platform play. Size and scale matter in terms of price. And market potential is a key determinant of value and interest by private equity players. They want to go into spaces that are cottage industries that haven't been consolidated yet, that are attractive in terms of growth potential. Now I'll walk through positives and negatives in terms of what PE firms look for. On the positive side, a history of profitability and positive cash flow generation is of paramount importance. They also look for the next level of management beyond a founder and CEO. How deep and broad is the team? They'll look to you as the founder to understand your market and growth drivers. They may not know much about this market, but they're interested in it based on your knowledge and transferring that knowledge to them so that they can understand that this is an attractive market sector. Private equity also looks for a future growth strategy, compelling products or services, and a competitive edge, your barriers to entry. The more organized and efficient the business is, the better. And whether or not you focus on key performance indicators is also important to private equity. On the negative side, businesses that are unprofitable and have slow or no growth are not as attractive or may not be attractive at all. A lack of management depth can be overcome by their knowledge of how they might supplement the management team. But sole reliance on the founder is a real issue. Lack of insight as to how to grow the business can elicit thoughts of this is a stale marketplace or the market has passed this company by. Weak knowledge of competitors is never a good thing. When potential investors know more than the people running the business, that's an issue. Weak sales and marketing, again, can be supplemented. Disorganized and unstructured will impact price. Weak financial backup is not a sign of a well-run business. Undisclosed liabilities and issues can kill a deal. And if you're losing the battle in the marketplace, it's another significant negative. Private equity firms are no different from any other business. No two firms are exactly alike. There are nuances, and savvy advisors know how to target firms based on seller criteria. Certain firms play their hand differently, and if an entrepreneur cares about his or her team, certain firms may not be as inclined to keep that team. So knowing that by your advisors is a very important aspect to this whole process. Also, knowing how they make decisions. Certain funds specialize by deal size or industry sector. Some will do domestic with offshore expertise for international expansion. Some firms are more hands-on than others and may impact an owner's desire in terms of which firms he or she is more interested in working with. Firms generally require some level of ownership rollover and a future role, whether it be for 1, 2, or 3 years. There's a question of existing management versus PE installed management and providing incentives for key individuals. It's also important to know how certain firms react to tough times. Do they run for the hills? Do they panic? Do they do significant layoffs? All important elements to know up front. And using an advisor who understands these firm nuances and the importance of showcasing your business across a broad spectrum of firms cannot be understated. There's a topic of PE versus a strategic acquirer. Owners need to understand nuances in how they each operate. A strategic buyer is generally in the same line of business, and acquiring you is tactical. You could be a very strong competitor to them that they would rather have in-house than compete against. Financial buyers are more oriented towards private equity. And they may have relevant expertise in your business as well, and they're seeking to continue to grow your business for another sale in the future. You need to understand and assess your own objectives to determine what is most important to you and discuss this with your advisors. Think about it from evaluating the prospect of organizational change and dislocations. There are also differences in the time to close in the overall due diligence process. A strategic may know your business inside out already, and the due diligence process may be shorter. Asking questions helps, but not everyone is forthright in letting you know what their plans are for the business. But a competitive process ensures a level playing field to maximize your sale value. Again, I thought I would share with you in kind of a compare and contrast mode, a PE firm interest versus a strategic acquirer. PE firm will be looking to continue to build your business and thinking about a sale of that business in the future. It may remain a standalone platform or be part of a roll-up strategy. Your vision and strategy may have more impact within a PE firm. Think of this as not a full exit, the possible earnout and future upside potential. The deal structure will typically involve debt, so it's very important that your company's business and cash flow can sustain and pay down that debt. They may maintain a greater level of normalcy in terms of your business culture and employee retention. There'll be flexible structuring options. And if competing versus strategics, it will force them to bid higher. Now, on the strategic acquirer side, generally a corporate acquisition, they'll typically subsume and integrate your business. They'll pay a higher price typically if it's of strategic importance to their business. They will also have earnout provisions and generally a 1 to 3 year retention package. They will seek synergies by streamlining operations. They don't need redundant financial activities and other aspects of your business on the general administrative side typically, and maybe even on the sales and marketing side. If stock is the remuneration, you need to evaluate its value potential and upside if there's a lockup. You need to evaluate the strategic fit and employee retention. It's generally more hierarchical and bureaucratic. You may have certain desires for a domestic buyer or an international buyer, and they'll likely manage the business differently. An international buyer may be more hands-off, knowing that the practices of how you run your business in the United States is different than how they run their business internationally. And if seeking the highest price specifically, this may be the best option. Again, if we move back to the PE due diligence process itself, PE firms will not leave a stone unturned. It is a very exhaustive and thorough process. This is a process that you undergo with the finalist. There'll be independent general and tax accountants, general advisors and tax accountants, and they'll review all historical financial information. Their legal counsel will review all documents and draft purchase agreements. Industry consultants may be used, particularly if they don't know the specific industry. Insurance, environmental, and other risk assessments will be undertaken. There'll be management and key employee interviews at a certain stage in the process, depending on how you with the advisors open up the process to this finalist. There'll be customer due diligence calls, but it's very important that this is the last step due to the sensitive nature of those contacts. I can assure you, stress levels will be high on both sides during this due diligence process. And don't kid yourselves. Their level of sophistication will dwarf yours, which is why having strong advisors is of paramount importance. And just when you think, what else could they possibly ask for? There will be more. The more organized and ready and efficient and prepared you are, the better. Your personal tax and wealth advisory planning should be done in advance. You need an advisor to run this process, control it, and act as your brain trust in concert with you. Now, during the process, the most important aspect of the business is managing the business. Keep your eye on the ball. Running the business on plan with your management team is critical, which is why at various stages, members of your team will be introduced that there is a sale process going on. Not everyone will be brought into the loop up front, as it's a distraction. But buyers monitor very closely your performance during their due diligence process, and they will look to adjust the original offer down or kill the deal if shortfalls exist. All eyes are watching everything during this due diligence process. It's very important that all inquiries route through your advisors. You want to be on script. Nothing will hinder a process more if you're unprepared, disorganized, or slow at providing data or missing revenue forecasts. It's also important to play offense. It's always best to disclose key issues. Surprises are not good, and you should assume that a sophisticated investor doing extensive due diligence will find hidden secrets. I cannot overstate it enough. It is imperative to manage your business successfully during the process. Seller beware. Find a neutral advisor, one who truly represents you. You may not understand this, but many advisors treat certain PE firms as go-to buyers, and they just want to get deals done, not necessarily favoring you, but knowing that those buyers are repeat buyers for them. You don't want to become trade bait. You want an advisor that's independent, not one that invests or co-invests with these PE firms, because they'll be interested in goodwill with the buyers, and their due diligence their interest and allegiance will lie with those buyers more with yourself. If they're investors, they're also interested in as low a price as possible to ultimately sell it for a higher price. A thorough process should include PE firms, strategics, family offices, and possibly competitors. What you share with competitors at different stages is also important to be thought through carefully. Domestic as well as international firms should be contacted. There's a great deal of interest from European and Southeast Asian firms in buying businesses in the United States. Again, PE firms are super sophisticated at all levels. Listen to the advice of your advisors and be prepared. Firms, PE firms, strategics, individuals doing due diligence will try to get you unscripted. Never let your guard down. After the deal closes, it's important for you to understand that you might be required to stay on for 1 to 2 years to ensure a smooth transition. This can be shortened if once the operation that's been acquired runs smoothly, or you may have an interest in staying on shorter or longer or taking on a different role within the business. Depending upon how the deal is structured, you may have cash at closing and a portion as an earnout. There may be long-term incentives, again with an earnout, that will include future appreciation. Think of it as a second bite of the apple, which can be extremely beneficial. You may have ongoing active leadership or a consulting role, and it really depends on what your interests are going forward. There will be escrows to cover representations and warranties, and a multi-year non-compete agreement. the last thing a buyer wants to do is ultimately compete with a seller. You should be prepared for a personal adjustment period, as nothing will be the same as it was before when you owned your business and didn't have to report to private equity individuals or a board in certain instances. I'd like to walk through some general industry statistics. This is a representation of the total private equity assets under management by fund size. As you can see, the larger funds control larger dollars within the marketplace. But if you aggregate the funds between 100 and 250 million and below, which tend to focus on mid-market and lower middle market, that aggregates about 16.5% of the total dollars. Taking a look at the timeline in PE activity going through 2017 deal activity was roughly on par with 2015 and 2016. 538 billion was put to work in approximately 4,053 deals. In 2017, you can't really see it from this chart, but in Q3, activity spiked and then decelerated a bit in Q4. Q4 accounted for approximately 25% of deal volume, or just under 1,000 deals. There remains a lot of dry powder for investment. I'll also point out that over 650 billion was raised from 2015 to 2017 alone, the highest three-year level in history. Multiples for solid, strong businesses are high. And if you take a look at 2017, we're at the highest medium debt levels, and it's slightly higher deal leverage than in 2016. It's a highly competitive market for high quality deals. Size trends are holding rather steady. Importantly, 89% of deal volume is in the sub $500 million range. Deal sizes remain elevated. The total number of PE-backed companies in the marketplace today is about 7,250. And over a third of those are greater than 5 years in terms of when they were acquired. And those companies are typically looking for acquisitions as well to continue their growth. As you can see, the median exit size by type is dominated by secondary buyouts. And secondary buyouts are where one PE firm sells to another PE firm to create liquidity. Deal flow continues as ongoing acquisitions occur when the new buyer takes over the particular deal. Secondary buyouts, there are about 548, accounting for 77 billion, and the median exit was approximately 400 million. And as you can see, despite several corporate mega deals, which represented much of the industry commentary in 2017, it was secondary buyouts that drove the median exit size to a new all-time high of approximately 221 million. I'd also like to point out that secondary buyouts are growing in terms of share, and strategics have dropped slightly. IPOs remain a relatively small portion of the market. Tech remains very attractive, and operating partners can help provide value. In due diligence, cybersecurity today is a very important component of a buyer's due diligence. And one thing you should always think about with your business is, can your entity provide recession resistance in the next downturn? As buyers will be fixated on understanding that as they look at transactions. B2B and IT are very strong and healthy. And I'd like to wrap up with, in your strategic investment journey, SiVal Advisors represents U.S. companies seeking optimal strategic investors, U.S. or international. We look for the best strategic fit to maximize the exit value. Markets are global today. The due diligence process is broken down into phases over a timeline. There's the initial assessment and preparation, which are some of the most important steps undertaken to ensure a successful process. Through your advisor, such as SiVal Advisors, we will contact prospects, do negotiations, receive initial letters of intent, and then follow-on letters of intent, and select a finalist typically, who will do very detailed due diligence. And then it's all about the legal agreement and coming to a closing. Why SiVal? We have U.S. and global M&A experience, broad transaction expertise, deep industry knowledge across an array of sectors. You'll receive senior level attention and superior service. SiVal professionals have executed over 500 transactions exceeding $12 billion in deal value over our careers. Here is our contact information, and I welcome any questions. Thank you for your participation.
That was great, Virginia. Thank you for your question. So we have a couple of questions that have come in so far, and let's see if we can take them. First of all, you used a term that one of our listeners doesn't understand. You called it about trade bait and the idea of advisors and PE firms, their relationship. What does trade bait mean?
Well, there may be a quid pro quo with a private equity firm that if I give you this deal, you may give me another transaction of yours to be the lead banker on. And so I think it's very important that you have an advisor that runs a broad process and does not just go to a few select investors. Advisors work for you, yes, but they also work on behalf of PE firms. And if one advisor sells a lot of businesses to one PE firm, you may be just being used as trade bait for another deal that they want to help sell from that business. And they're not out there trying to secure the highest value by running a broad process with multiple offers. And that's how values increase. Bidding processes, multiple offers, everyone wants an opportunity to invest in you. That's how the price rises. And it's very important that you have an advisor that understands that and knows how to navigate a process for you, with you as the core client.
So we have a second question and again, we'd like to remind you that if you have a question, please go to the Q&A box on your online and submit the questions there. The question came in, what about PE firms operating internationally? Are they mostly U.S. centric? I think you covered that, but it seems like we want to have a little elaboration here.
PE firms are broad. They're international, and they're international in terms of their growing businesses. There are European entities that are looking for outposts in the U.S. For example, the company that I was at, we were acquired by a European entity. We had operations globally across Asia, Europe, but the largest market for us was actually the United States. And this European entity was looking in the division that I built out for a foothold in the U.S. And I had acquired companies on the West Coast, Midwest, and East Coast. And that was going to provide them a launch pad for one of their core verticals for their entire business in the U.S. And so it was very attractive. The world is global. Sales and marketing is global. Buyers are global.
So several people have asked this question, and it seems to be a common thread now. He said, I have seen many PE deals where the PE firm immediately brings in their own executive and operating team. Is this inevitable, or are there executive and operating skills that PE firms find attractive to retain?
Yes, it's all about the style of the PE firm. And as you get into bigger and bigger deals, there may be more of a tendency to change out management. It really depends on the nature of the PE firm and the expertise within the team, which is why the broader the team and their core expertise in a given vertical, they can be pivotal to retain and provide upside incentives to continue to grow the business. If they're weak and really don't demonstrate the capability to be organized and efficient, focus on key performance metrics, then the private equity firms will look to enhance and strengthen that team, and sometimes, may replace the entire team. It really depends on, what they find in due diligence in many regards, how highly valued they view the individual team members. Remember, always have yourself and your executive team be prepared thoroughly before they talk with a potential private equity owner. It's in their best interests and your best interest as the owner of the business to showcase your business and your team in the best light possible.
Well, a related question here goes, you talked about what happens after deal closing. Can you elaborate a little more on what kind of earnouts and things like that people may be able to expect?
Well, there's the earnout and there's also rollover. Rollover is where they ask and like to see a portion of the proceeds rolled back into the business such that you have a greater, you retain an equity stake going forward. An earnout is based on the plans that you show them, generally for a year or more going forward. Buyers want to ensure that what they're buying, you're not running for the hills, that the numbers you put in front of them for projections, you believe in, and you're willing to stand by, and they're not just numbers created out of thin air. And so they're holding you responsible, you and your team responsible for delivering those numbers for a period of time.
So I'm going to combine two questions into one here. One was about due diligence, and one was, what kinds of things stop a PE firm from going through with a transaction? It sounds like those was related. Any things from your experience you've seen that have been real deal killers?
The most significant deal killer for any deal is missing your numbers during the due diligence process.
Good point.
That is a very important aspect of running a business. Private equity owners don't care that they are draining your time and your management's time. They want to see that you can still manage a business. And this, again, is where it's very important for your advisors to take control of the process from you and enable you to keep your eye on the ball and run the business, and they will run the process, which again is why preparation is critical to a successful outcome.
Well, I think that's all of our questions for today. We'd like to thank you for tuning into Silicon Valley M&A Insights and Virginia Turezyn of SiVal Advisors. Please check the SiVal Advisors website and Silicon Valley M&A Insights website in the next day or so. If you'd like to do this, we're going to repost this recording of this webinar. If you'd like to share it with friends or colleagues. And any questions, please contact one of us here at SiVal. And if you are considering a potential M&A event or an exit, we'd certainly love to hear from you.